Okay, welcome to our panel number 5, Grappling with Hierarchy and Centralization. My name is Pocklington. I'm the director of the Scholarship Initiative at the Institute for New Economic Thinking. I'm really glad you're here with us. I just wanted to quickly give you some context about the panel. And my fellow panelists, Alex, Howlett, and Larissa, Lima, are together with many others that are in the room in a regular reading group that's happening most Wednesdays and many other times around money and political economy issues. And none of us are full-time academics, so this is a great opportunity for us to actually develop our own ideas and put some ideas forward. So we're really glad to share those with you today. And our commentator today is Anush Kapadia, and I'm really glad that he's willing to discuss our papers. The way it's going to work is that we're going to keep our presentations as short as possible because the nature of the conference has already produced a lot of potential discussion points, and we want to emphasize that also in this discussion today. So we're going to go into the order of Alex, Larissa, and myself, and then with Anush with the comments. So I'll let Alex go first.
Yeah. It's on the desk. Just go to the desk. Okay, so there's a lot of talk about hierarchy at this conference, a lot of talk about money too, for some reason. But we're not always talking about, or at least not always emphasizing the same things. So what I want to emphasize today is an underlying hierarchy in money, a structural hierarchy that actually limits what we can do with money, what's possible with money, and in particular, monetary sovereignty. So these limitations are easy to see under something like a gold standard, but if you understand this hierarchy that I'm going to be talking about today, you'll see that they don't go away when you leave the gold standard. So by thinking about money and understanding this hierarchical structure underneath it, we can develop more realistic expectations about what we can do with money. Okay, so I want to start by defining money because a lot of us use the term money to mean different things, related things, but not always exactly the same thing. So instead of kind of identifying an object out in the world that people call money and trying to understand it, I want to start with a concept. And that concept is a standard settlement instrument. So you might not agree with that definition of money, but it's the one I'm going to use. And if you adopt it for this talk at least, you might find some insights are useful here. So standard settlement instrument. So it's basically the thing that everyone generally accepts as payment to settle debt obligations. So no large-scale trade or payments community is really going to be able to exist without coordinating on some kind of standard settlement instrument, so they can actually trade with each other efficiently and at a large scale. Now you might, I think there's some controversy about where money comes from in this conference, but you could certainly imagine that if people are trading with each other and there's a particular thing that they're trading that a lot of people are going to want this thing, there's an incentive to say, oh, I'm going to take some of that thing because I know I can pass it on. I know that I can exchange it for something else. So you can imagine kind of a standard settlement instrument being coordinated on kind of organically through trade. And of course, it's true that government can come in and facilitate the process. They can provide an outlet for something by accepting it as taxes or something like that. So all of that is true. But the most important thing is, and this is something that Alan Young emphasized, that money has to have an assured outlet. The community is not going to adopt something as money unless it has an assured outlet. And then once it is adopted as money, of course, that means there are a lot more assured outlets because not everybody's accepting it, right? So money, the settlement instrument, is something you can spend right now to settle debts. You don't have to borrow. You don't have to sell anything because you already have the money, so you can just spend it. Now, money is a standard. It's a standard settlement instrument, but it also defines a standard. It defines the pricing standard, so the unit of account or standard of value. A dollar is both a thing you can spend and a thing you set prices. We all know that. There are some people who like to say that the standard of value logically precedes the actual instrument that you can trade back and forth, like John Hicks' market theory of money kind of thing. He notices that, well, you can set prices in money, but then you can settle in something other than money, or maybe the cash flow is offset or something, and you net them out, and there's no actual money changing hands or something like that. All of that is fine. It doesn't change the fact that the settlement instrument is still kind of notionally there. There's these notional cash flows, and just because you net them out doesn't mean that there's not still something going on there. So the settlement instrument and the pricing unit, the pricing standard, are both important. They're two sides of the same coin, and which one logically precedes the other is not super important for right now. So Henry Dunning MacLeod had an interesting definition of credit. So we're used to thinking of credit as a promise to pay or a promise to deliver something. It's a promise made by someone. But he had a more general definition of credit, which is credit is anything you accept because you know it can be passed on, because you know it will be accepted by other people. So that's the definition of credit that I am adopting here, because it allows us to think of money as the highest and most general form of credit. That's quoting MacLeod. And what he means by the most general form of credit is that money is not only something that you accept because it can then be exchanged, it's something that can be exchanged for everything, can be exchanged for anything. He's saying that money is the most general form of credit because it's the standard settlement instrument. So it's two ways of kind of defining the same thing. So there's banking. Well, I should say that some you can, like, what we know is as credit is a promise to pay, and that also is a form of credit under this definition. A promise to pay money can sometimes be money in itself. So Joseph Schumpeter said, you cannot ride on a claim to a horse, but you can pay with a claim to money. Not all money, not all claims to money, right? It's just a 30-year loan or something. You don't pay someone with that. Usually it's securitized or something. But in order for a claim to money to also be money itself, it basically has to be a demand claim. You have to be able to turn it into money right now. So the fact that you can turn it into money right now means that other people will just say, oh, I'll take this thing that I can turn into money whenever I want, so they'll accept it as payment. So now you have bank deposits, which are in themselves a form of money, which are a promise to pay the cash that the bank is promising, the thing they're promising. Now, something to notice about this is that hierarchy emerging, right? So the centralization and pooling of reserves and the centralization of settlement, that is hierarchy, because now you have these bank deposits that are one kind of money that are promises to pay a higher kind of money. And this is a structural hierarchy. It's who's using whose liabilities as money. It's not a hierarchy of liquidity. It's not a hierarchy of moneyness or power necessarily, although these things maybe can be associated with it sometimes and under certain conditions. But if everything's operating normally, all the monies at every level of the hierarchy are fully 100% money because they're the standard settlement instrument at that level of the hierarchy. So the top of the hierarchy, we talk about money being a standard settlement instrument. The top of the hierarchy is what we can call the standard money. So it's the standard, right? So the top of the hierarchy is the monetary standard, and sitting at the top of the hierarchy, managing that monetary standard is the central bank. It's the bank for the banks. So you've got two different layers of hierarchy going on there. Now, under a gold standard, the central bank faces the same constraints as everyone else, that if they don't have money, they are in trouble. They can't make their payments, or if they're not able to get the money, right? So they have to settle their debts too. So they face this kind of settlement constraint. It's the same thing that you or I have to face. We can run out of money. Banks can run out of money too. Money is something you can run out of pretty much universally. A central bank can choose to violate its settlement constraint and suspend payment of whatever instrument is above it, gold, I guess, or some commodity or something. If we're imagining that the central bank actually has a settlement constraint, they can violate that settlement constraint to relax the settlement constraint of those below them, and you see that sometimes in the gold standard. But today we have a credit standard, in the McCloud sense, right? We have just money that is not a claim on anything specific, but we use it because it can be exchanged for anything. So the central bank today does not face a settlement constraint per se. It does face a monetary stability constraint. So when we think about what, I should go to the next slide. When we think about, monetary stability, so money as the most general form of credit needs to be exchangeable for anything. You want its purchasing power to be reasonably stable, right? You can't, if something's going all over the place in terms of what its purchasing power is, it can't be the most general form of credit. You can't use it to exchange for things generally. It's not going to work. So that's monetary stability. Financial stability has to do with people being able to meet their debt obligations. So that includes banks. That includes keeping these kind of one-to-one par relationships in the hierarchy. If there's too much financial instability, then things that used to be money might stop being money when the banks fail, right? Now, in terms of how central banks manage this, if you're on a gold standard, you're just managing cash flows just like any other bank, and you have to keep, make sure you have sufficient reserves of gold to be able to pay out gold when people come to you. If you are on, but one thing central banks do in a gold standard, one thing the Bank of England did was they started doing monetary policy. Now, the interesting thing about that is they didn't want necessarily the buyers and sellers of gold to come to them. They wanted them to settle with each other in the market. And they used monetary policy to make it so that the price of gold in the market, the price people wanted to pay each other in the market, was the same as the price that they would get by coming to the central bank. So if you can do it in the market, you don't need to go to the central bank. So they have this monetary policy that stabilizes the price of gold in the market. Now, if you are a central bank managing a credit standard, you do something similar. Your monetary policy could target the price of gold, and we could be, like stabilizing the dollar against the price of gold today without having a vault or anything. We don't need to have a vault. But since we don't have a vault, we can actually do more. We can do better. Instead of stabilizing against one arbitrary commodity, we can stabilize the currency. We can stabilize the money against a basket of commodities. And that's what we do, and that's how we achieve monetary stability, purchasing power stability. But something you might notice is that the central bank of today is facing a similar constraint to the central bank under the gold standard. It's not an explicit settlement constraint. They can't run out of something, but the price of the thing they're trying to stabilize can go out of whack. And if it does, then it stops being as good money. And the reason why they were pegging to gold in the first place was to piggyback on the monetary stability of gold, for better or for worse. It's not the most stable thing. We're doing better now, which is why we're not on a gold standard anymore. So the government, does the government face a settlement constraint? So the government, I'm thinking about the government and the central bank separately right now, and the government uses the central bank's liabilities as money, just as we use regular banks' liabilities as money. And the business of a bank, what they do, we talked about how a bank can, its own liabilities are money, and our liabilities aren't money. I think, we've all, or a lot of us have heard this quote from Heinrich, where he says, everyone can create money, the problem is getting other people to accept it, or getting it accepted. What he means there is that anyone can promise to pay money. Is someone going to accept that promise to pay money as an asset on their own books? And that's hard enough as it is. Like if I write I owe you $1 million on a napkin, I don't think any of you are going to accept that. And so that's a challenge in of itself. And then the even harder challenge is, can you establish common knowledge that your promise is good, right? And that's what you have to do to make it money, because it's not just about being able to give it to one counterparty, it's about that person knowing they can pass it on and everyone knowing that your money is good. Otherwise, or your promise is good. Otherwise, it's never going to become money. Even if the person trusts you, they'll just come back and take the money. Even if it's a demand prompt, right? It's not money unless everybody trusts that it's money. So the business of a bank, the shortcut, you don't have to become a bank for your liabilities to become money, despite what I just said. All you have to do is go to a bank, and they'll take your liabilities, and they'll give you something you can spend as money. So this is called monetizing debt, and this is what banks do. You go to a bank, and you borrow from them, and they've converted your debt into money, and now you can spend it. So the government has a bank, just like we do, and their bank is the central bank, and when they borrow from the bank, the central bank, is monetizing government debt. You hear about monetizing government debt. What is that? That's just normal banking. That's what banks do. They monetize debt. Let's move to the next slide here. So there's an international money hierarchy. Under the gold standard, it was a par hierarchy. So they were all instruments that were promises to pay gold, 1-to-1. And everyone was kind of piggybacking on the monetary stability of gold. But gold is expensive to ship. So if you are in New York and you want to, and there's going to be a market for instruments that are foreign claims for gold, right? So sterling denominated instruments in New York. And you would expect that those instruments would trade at par because they can be redeemed at par, but it's really expensive to ship gold. So what ends up happening is there ends up being a market for this foreign exchange, and the exchange rates can move around. And they move around within a spread determined by how expensive it is to ship gold. So you essentially have a floating exchange rate system there, which I'll get back to in a moment. Now, in the 20th century, par with gold was violated. And the international the international system reconstructed itself around the dollar, but it's still the same thing. The gold standard world was a floating exchange rate world, and today's world is a floating exchange rate world. We had gold parity. There was a spread around gold parity for exchange rates, and now there's the equivalent of gold parity today is purchasing power parity, right? It's monetary stability. And there's another parity, which is, so purchasing power parity is just if the relative purchasing powers in the different countries are different, people are going to start, goods and commodities are going to flow. And then there's interest rate parity too, which is that interest rates are going to adjust between the different countries. And if there's too much of a gap between the relative interest rates, then everyone's going to borrow where it's cheap and lend where the interest rates are higher. And the problem is that the central banks are controlling interest rates in the name of maintaining purchasing power. So the purchasing power parity puts pressure on the interest rate parity. And it really ends up being that there's movement around all these spreads, but there are these constraints there. So kind of in the big picture, you can really only choose one. You can only choose purchasing power, price level stability, or you can choose interest rate parity, or you can choose controlling interest rates, or you can choose controlling the exchange rate. There's not really anything else you can do. So just to bring us up, floating exchange rates, we just did that. I'm terrible at slides. So when we look at money, we're looking at different phases of the same underlying structure. Money and its hierarchy are natural features of markets, and it's vital market infrastructure. And the standard settlement instrument, the most general form of credit, if you understand the structural hierarchy inherent in the logic of money, you understand not only what we can't do, but what we can do. So I think, not to put a damper on everyone, but it's useful to kind of know what the constraints are. That's it.
Are you one of the presenters?
There's a full screen option just below there. Yeah. Just bring your mouse a little bit below there. Okay. And one. No, just yeah, to your left now. To your left. Sorry, yeah, that one. Oh wow.
So, how close is the first to this?
Just about 2 hours.
Thank you, Alex, and thank you everyone for your time. It's nice to be back at the place that I did my undergrad, MBA, and MPP, and I always secretly wanted a JD as well. So our panel is about hierarchy and decentralization, and I want to talk about what that means from new technology perspective. So that's where I spend my time. So I co-lead the Future of Money initiative at the Oliver Wyman Forum, which is the think tank of a consulting firm that does a lot of work with financial institutions and regulators. A quick roadmap for today. I'm able to move the slides. No. The mouse. There, okay. All right, quick roadmap for the presentation. I'm going to start with establishing the challenges of understanding banking. And I'm going to take a money view perspective, as that's the lens that I take on my work, as I found it really productive from an explanatory perspective. Then we're going to talk about digital assets and what they represent as the money as a democratic medium project. And then we're going to assess the track record so far. We're then going to go back to the money view and see what that lens has to say about the future prospects of the digital assets project. And then I'm going to end on questions rather than answers, as it's going to be an invitation for a conversation and collaboration. All right, so what are the challenges of understanding money? I'm going to speed through this. Hopefully it's familiar, and if not, check out Perry's essay, which speaks more eloquently than I'll be able to do. So first, on the alchemy of banking. Banking is essentially a swap of IOUs. Banks take risks on both sides of their balance sheet, when making loans and when creating deposits. People generally dislike it because they feel like banks are having a free lunch. Money is also essentially hybrid. It's both public and private. And people dislike it at both ends. Both ends of the political spectrum. Third, there's an inherent hierarchy to money. Public money is better than private money, even though they trade at par, And there's hierarchies across both the public and the private spectrum, just made up of chains of promises. And people don't like it because it sounds unfair. And then fourth, and finally, credit is inherently unstable. It's subject to feedback loops. Sometimes things don't go quite as you expect. And people don't like this because, well, it's a bummer to deal with bubbles. So what is the promise of digital assets? What are they trying to do? Let's start with the origin. It's 2008. It's the height of the financial crisis. Dissatisfaction with both banking and central banking is at a point where you could say, hi. And there's a paper that comes out describing Bitcoin, calling itself a currency, and it's built on this new technology called blockchain or distributed ledger technology that allows peer-to-peer transactions at scale without relying on a single specific intermediary. Why is this interesting, or why does it promise new things? Well, first, you have a new way to ensure participation while individuals still retain custody and control over their funds. Sure, you can say people have control over the coins in their wallets or the gold that they keep under their mattresses, but physical goods are expensive to move and transact with, and that cost scales with volume. So the pure convenience of outsourcing custody and transacting is at least one story about the origin of banking, but in this crowd, we know that that's not the only story. Second, the way that this accomplishes this peer-to-peer transacting is by settling transactions without having to go through a specific balance sheet. So the transactions exist outside of an intermediary's bilateral credit relations. Now, this is not to say that credit relations cease to exist, or that what's being settled isn't bilateral credit relations in and of themselves. It's just that the mechanics of settlement can exist without relying on an intermediary. The hope is that this technology and these facets of the technology then allow the emergence of a different type of financial system, one that is self-sovereign, so people retain control of their assets, one that's inclusive, borderless, innovative, because it's open for anyone to participate, and it's independent of central authorities, both public and private, making it trustless. And that word does a lot of work. That's a separate conversation that I'm happy to take in the hallways. So I do want to note that decentralization is not the only vision that is being proposed using digital assets. I'm not going to go under this, but it's just the one that I'm focusing on today, since we're on a panel about centralization. All right, so what's the track record? There's been a lot of really exciting innovation. Decentralized autonomous organizations, or DAOs, they aim to be a new form of governance, that they use technology to connect people around the world and to coordinate in a transparent manner. Then you also have decentralized finance, or DeFi. So some forms of distributed ledger technologies allow not just peer-to-peer transacting, but also the deployment of code that specify more complex forms of transactions and services. So this is what people are referring to when they talk about smart contracts, protocols, dApps. So lending, trading, investment, all can be created as products deployed on distributed ledger technology. And as an added bonus, you can combine the code and create even more sophisticated products. And then there's decentralized identity. I'll skip that one for the sake of focusing on money, but it's about giving people more control over their data. Track record? Well, a little bit disappointing. So there's been really high concentration of ownership, really bad Gini coefficients, and what that's meant is also a lot of concentration in voting power. Now, there's some alternatives that people try to do to make it more fair, but it's still an issue. And there's also a lot of concentration of activity and where it's located, both on chains, as some specific blockchains or DLTs dominate, as well as off chain, as you see geographical concentration of some important functions in the ecosystem. All right, so what does this mean, though, for the future? What does applying money view have to say, or what can it offer? So I'm going to go back to these 4 challenges, one by one. So first, there's this idea that maybe tokens and smart contracts can replace IOUs, and maybe you solve banking as intermediaries and the ultimate banking. But when you think about it, an IOU, a balance sheet, they're all just different ways to capture promises. And you have all this rapid innovation, and what you actually see is a proliferation of different types of promises. Now, some of these promises are more operational in their nature. It's about creating a friendlier interface, safer forms of custody. So none of that would be in tension with self-sovereignty and self-custody. However, you also have a lot of innovation that are promises of monetary value. So it's guarantee of value across ledgers, guarantee of stability of value over time. You can call it a token, but would it not be an IOU? And still, you can still ask the question, but isn't it banking? So pure DeFi is still very much in the narrow banking space instead of fractional banking. However, they import a lot of their elasticity from the off-chain real world. And we'll talk about that more in a minute. So my verdict, people can disagree, is that automated banking actually remains quite strong in digital assets today. What about the essential hybridity of money? Are cryptos purely a private money system? Well, today it's definitely not the case. So a lot of payment and trading activities are done with stablecoins, and these are tokens that promise stable value. And the most popular stable value is the dollar. So crypto too is a dollar system. But you can argue, but what about the future? So we really still need some mechanism to address liquidity in times of crisis. And it's a question mark on how to do that with decentralized governance mechanisms. Not to say it's impossible, but that's something still to be proven. All right, but it's decentralization, so surely there's no hierarchies. Well, the ethos of self-sovereignty really clashes with this ethos of innovation and just the pure economic power that comes from specialization and outsourcing. DLC themselves, while there's a lot of possibilities, also have a lot of friction. Consensus-based settlement is expensive per transaction. So you see the emergence of these new solutions that create interlocking promises just based on transaction efficiency. So you go from Bitcoin to Bitcoin traded on an exchange like Coinbase. So this is the emergence of what people call CeFi, and you're moving away from self-custody and the network is settling to settlement via the balance sheet of different intermediaries. All right, but what about on the pure crypto side? So settlement ledgers, or DLTs, they have different functionality. So you can't do DeFi as easily, or at all, depending on the other discussion, with Bitcoin. So what people do is they issue Bitcoin on DeFi-friendly blockchains. So they call it wrapping the Bitcoin. So that adds a layer to the hierarchy. And then once you have Bitcoin in the DeFi ecosystem, you may add another layer to the hierarchy by adding interest rates, and then from a wrapped Bitcoin, you have a Bitcoin in Aave's lending protocol, so it's an AWBTC. So you see more and more layers of the hierarchy proliferating. And I'll give a shout out to Sebastian Derigo. So he made this chart, and his crypto banking website has a ton of crypto analysis with a DeFi lens and a money view lens. And this is just on the pure crypto side. I haven't even done like a money hierarchy view when you go in and consider fiat stablecoins. So the verdict here, I would say, is a lot of hierarchies, actually. Now, what about instability of credit? So the promise of DeFi is based on self-custody, which we talked a lot about, as well as transparency. If all of the information is on-chain, you can have better monitoring, better risk management. Now, the self-custody ethos, a pure DeFi protocol for a stable coin, will be more like a collateralized lending position than a pure banking deposit. That structure actually made it pretty safe towards crisis that exists in the purely DeFi realm. But DeFi and crypto, they're importing elasticity from the off-chain world. So you actually saw depegging and a lot of issues when there were crises in the off-chain. So with SVB, then you then observed depegging of DAI, which is the most popular DeFi-based stablecoin. That said, I think there's a lot more that we can ponder and think about on the transparency side. Now, some would say transparency only serves to exacerbate crisis. It's like adding visibility to discount window. Bad idea. But if you consider transparency as an element of design, and distributed ledger technologies have different ways to make different types of information available to different participants, maybe it can lead to better monitoring. Maybe it can lead to better identification of where bubbles are coming up and what are the relationships of potential contagion. So I think probably more to offer in that regard. All right, so what does this mean coming all together? In my view, there's a lot to be said about the value of promoting access and self-custody, but it's been really challenging to achieve that at scale while also completely disintermediating financial intermediaries. But that's not to say that there's not a lot of promising questions to explore, both on the financial side and on the more thinking of the connection to democracy side. So I have here just a few of the questions. Won't go into them at this moment, but happy to talk more if you have ideas on how you would answer this. Would love to hear about it. Hopefully this is the beginning of a conversation. All right, and thank you.
Okay. So thanks again. I'd like to sort of maybe start, and I'm cognizant of time because we started 10 minutes late and we wanted to have time for discussion. Maybe a quick preface about the title, Managing the International Hierarchy of Money, and what is my personal interest. I have written my master's thesis on Germany in the 1930s, in which Germany was from a poor country pushed to the periphery and was grappling with the ramifications of having lack of access to sterling dollar finance. And there was a particular set of policies that Germany had to grapple with its positionality in the hierarchy, and that was my starting point. So there was a way of disengaging with the international hierarchy and creating its own sort of system around it. That's the Schaftian system that we kind of know. But today, I'm also interested now in peripheral countries today. That's maybe the main focus I want to sort of point to, which is how would from a money group perspective, from a key currency perspective, how would a peripheral country position itself in order to integrate into this hierarchy? So there's a way of developing outside of the system. There's many sort of approaches that we could point to in the 70s, the structuralists that are trying to develop outside the system without integrating. But I think I would like to point to the key currency approach will say there is an argument for integration and for trying to be part of this dollar system. And I have this graph just to illustrate the nature of the system just before the global financial crisis. And then it's about centralization. And these are gross capital flows around the world, and you can see the dimensions of what we're speaking about. This is from the BAS paper called Breaking the Triple Coincidence of International Finance. And this paper has influenced me a lot because it shows how deeply ingrained in market practice the dollar is today. There's many things to say about this, but I'll just leave this as an impression of what we're actually dealing with. This is what Anush said yesterday. These are the OECD countries and China and the emerging markets that are integrating in dollars. And what I would like to emphasize here is that this is largely an offshore system. This is largely not US domestic banking. This is offshore banking in Europe, in other countries that are using the dollar in order to have these cash flows, these capital flows grow. just to keep that as a sort of a starting point. But here we are. I would like to connect this right away with Kindleberger, who then said, when we're thinking about the world, I just need to read this here, the model for the world should be the integrated financial market of a single country with one money, free movement of capital, at long and short, the quantity theory of money employed on trend, but through discounting in periods of trouble. Just to start us off, what Kindleberger imagined was exactly what we know from Perry's presentation previously, was how the US integrated before World War I, that there became one money and one integrated capital market with the onset of World War I, that there was the raising of one capital market that was then stabilized through the Fed, and the creation of the Fed as well. So this is just the image that we have. So Kindleberger imagines that what we see here too, we kind of see one money, dollar, in one capital market based on this dollar. These are dollar, this is sort of the tendency that Kindleberger already anticipated. So these are sort of forces, as Perry calls Darwinian forces. We can agree or disagree if this is inevitable, but this is definitely what we see as a reality today. I will skip over this next question because I think the obvious question is, does it have to be the dollar? I think this is a huge debate, and I wanted to spend more time on this, but I'll just try to make this argument as briefly as possible. There are other international currencies. I think we all agree that a globalized world needs a global money. I think that much we can accept. The question is, what should that money be? And of course, this is not the first time we're debating this, but the fact is market practice dictates that it's the dollar, but we could have other systems. We could have the SDR. I just leave us with the Kindlebergian provocation. Should we be using what should be the world language? The analogy is very powerful. I think it's good to explain to this audience how language, he has an essay about language and power. His argument is, well, we should strive, some people say we should strive for a world language like Esperanto. Everybody should learn it as a second language, and that would be a more fair, equitable way of engaging in the world cultural scene. Or should it be English, which is already the dominant one, and it used to be French, and the French are not resenting. He's pointing the French are really resenting exactly in that time in the 60s that English has overtaken French as the main language. And so he makes the point, English is used by anybody outside the US, even if there's no American or Brit in the room, it's being used. It's market practice in that sense. So just Kindleberger sides with, let's use what people are already using, let's use what's commonly used, let's not overcomplicate things of trying to go into another language that everybody has to learn in addition to what's already being used. So that's maybe to summarize the Kindlebergian argument. There are other arguments. I said I would not get into this, but there are, of course, arguments for international currency to be managed in a multilateral framework. The arguments are, of course, that everybody's at the table, it would liberate the dollar from its international responsibility and so forth. I will just make that point here that part of the argument for another currency is that we cannot trust the US to make decisions in the interest of the rest of the world, if we're using the dollar as the world settlement currency. Now, that might be true. However, Kindleberger has an argument that multilateral decision-making inherently also fails at a number of fronts. And I will not get into it, but it's quite obvious. We can just take how the United Nations is unable to act, it's unable to respond. And for Kindleberger, the main argument is that we need a leader. Whatever multilateral framework we do choose, it needs to actually have a responsive leader that can respond to crisis in a timely manner. When we talk about money, the response of the leader has to be instantaneous. You cannot wait a couple days for you to make up your mind. Classic example, Great Britain could have been saved in 1992 if Germany had given them a swap line in the other direction from staying in the peg. George Soros probably knew that decision will take a couple days. In the meantime, the markets, the decision will not happen instantaneously, and therefore the rest is history. Britain had to go off the peg with the Deutschmark because the response was not timely and immediate. And that's the main Hilbertian argument against multilateral frameworks. So if we are gonna spin in an environment where multilateral frameworks are there, we need to have a system that can respond immediately at scale with unlimited liquidity. So that's the one, I think Hilberger could imagine something like that if there was a BIS or IMF with those powers, we would be fine. I will not get into this, but Keynes versus White's, that's a classic debate, but basically I would just like to sort of say that Ben Steele, who wrote the history of Bretton Woods, kind of says, well, had sterling still been the strongest currency, Keynes would surely not have proposed banker. So so this is kind of just that on that front. So let's get into a little bit now into the core question. If the dollar is the currency that we have currently, and the system is as it is, I would like to now go through the thought experiment. What could it actually deliver? What global good could the system actually deliver if we really think it through in a Hilbertian sense? Hilberger in 1967 acknowledged that the dollar is the global currency, and he said the dollar has to lead. In order to lead, it needs to recognize that it has an outsized importance for the global capital markets. So he proposed in 1967 the idea that the US should not have only a federal open markets committee, but really it should be an Atlantic open markets committee with other actors being listened to, but the US still making the ultimate decisions. That's maybe in a more enlightened way, we could even have joint decisions, but that's hard to imagine. But the decision would still be by the Fed, but it would, at least in this sense, you can see the idea that officially that would be one way to do it. The thing that I would like to go to is, so this is taken from Perry's presentation from Boston, the BU conference that we had a couple weeks ago. This is the current hierarchy of money, currently as it stands. And this is essentially what the core of the system looks like. It is inherently, Perry calls the slide that I adapted the hybridity of hierarchy. The top of the system is inherently private. It's private capital markets. You've seen this from the very beginning. I'll go back to here. This entire system is completely private. It's offshore private. This is backstop at best with public institutions. That's why I think Perry rightly asked, is the dollar actually within the US domestic sovereignty or not directly? But that's a big question. Yeah, I'll try to speed up. But just to get the point clear about what the key currency approach does. Here we see the dollar leads and the other main currencies follow. And the main objective is that we create exchange rate stability amongst the key currencies. Exchange rate stability amongst the key currencies. That requires that there's alignment of monetary policy between the major currencies. In this case, the dollar, the euro, the yen, the pound, and the Swiss franc. Why? Because they are financially integrated. They're acting as one capital market globally. That's why they have to essentially make monetary policy globally together. This is all the functions that a global leader needs to fulfill according to Kindleberger World and Depression. These are all standard liquidity provisions that we know, maintaining open relative markets for stressed goods. I mean, we all know this, we know what the lender of last resort looks like. For instance, in the 1960s, when he first developing these ideas, the IMF was only doing number 3, for instance. So we need to actually do all 5 functions in order to be a functioning leader in the system. So I'll speed it up now. Just to summarize, and get to the actual point of discussion, which is global public goods should be, according to the key currency system, stability. And here in particular, stabilizing the core. And there's much more to be said about this. Cooperation amongst key currencies, leadership and followership that generates stability, and this will also mitigate hot money. Hot money meaning short-term capital flows. When there's a dominance of short-term capital flows, you undermine the ultimate other global good of long-term capital flows, which is ultimately what we want from the system. We have all this excess, incredibly abundant amount of capital. We want it to go long-term to the places where it's actually needed, the global south. Hot money, there's the whole financial history of Western Europe is about how when there's competing monies, and you have multiple currencies or multiple settlements, you actually encourage short-term flows because you're trying to understand, am I using the euro or am I using the dollar? And there's short-term capital. There's a tendency even towards key currencies to mitigate short-term capital flows. There is a rationale, according to Kindleberger, to sort of an adapted Gresham's law. We want to strive at one settlement internationally to not induce short-term capital flows between competing international means of settlement. The ultimate aim here, and that's really, I think, what I'm really interested in, is that when this system is stabilized, we induce long-term capital flows. For development, for the green transition, for the green finance gap, we can borrow at scale. All right, let's get to the last point here. How does somebody who has very few capital flows coming their way in gross terms, how do they become part of this flow? That's the provocation here, according to Kindleberger. This is I've taken from Perry. Once we have one system, one global ecosystem, then there is and the system is somewhat integrated and it works according to the ideas of the key currency idea. We have a sort of hierarchy of financial development that is also in the hierarchy of money I mentioned earlier. We want young countries, young borrowers to borrow a lot, domestically and abroad, as much as they can because they have so much need for capital. More mature debtors can start repaying, and the global north that has, not as many investment projects that are profitable, they should be lending to these countries. That's the idea. If you have one system, you can actually allocate capital globally in this way. And it should happen this way. That's the Kindlebergian provocation. And lo and behold, it's starting to happen. This is also taken from Perry's slide, but this is just trying to show you that since about the last 10 years or so, we've seen a massive increase of dollar borrowing in this offshore market by major developing countries. This is all an uptake of the ability of these countries to start borrowing in dollars, especially bond markets, but also other types of dollar lending and borrowing. And the funny part is, again, this has nothing to do with the US. The counterparties have in general, no US counterpart. Perry mentioned this briefly yesterday. It's Japanese investment companies or insurance companies that are buying Petrobras Brazilian bonds that are being issued. Some American BlackRock as well, but this is inherently an offshore system still. So that's interesting. So this is the question. Now, I want to just quickly make you understand that this process of integration is, of course, not easy. And on the right-hand side, you see that there's a lot more work of central banks to manage and interface with the system. This will require a longer presentation, but what I would like to leave us with is the following. This is not some plea for some neoliberal opening of capital accounts and forget about it. Kindleberger had another argument that was super important in this environment, which is if markets don't work, don't use them. And obviously, when we look again at our graph, the potential for capital flows is huge, but the markets are small. Markets can be overwhelmed, they can be very disruptive, even reversals are possible. So this is not an argument, initially, for just simply opening up and hoping for the best. It's for it's an argument for a careful integration into this capital market, this global capital market, where capital is abundantly available and where capital is cheap, both of which is a problem for developing countries to raise the necessary capital domestically. If it is available, it's too expensive. In a lot of countries, it's not available. And so this is the challenge. It's not pretty. I don't want to paint a rosy picture. This is a thorny process. But if we're asking, where's the development gap? Where's the finance gap? The money is there. We need to think about how we tap into that potential. We want a system where all this capital that we do have available actually gets employed in the places where it's needed. And I'll leave it there. For the discussion, I have some other publications, domestic capital controls, domestic borrowing, lateral regional integration, but yeah.
Great, thank you. My thanks to the panel for inviting me to give comments. Some of this will continue the conversation from yesterday. But I want to just initially point out that the balance sheet method, the money view method, is a method, and that if we have sort of disputes, they're in a sense domestic disputes within different sort of uses of this method. So I'm just going to go Alex, Jay, and then Larissa, just because that's the order in which I have it. So Alex, I mean, you start with talking about hierarchy, and you start with the means of payment function of money, and there's definitely, settlement is naturally hierarchical because it has to be something outside us, right? There's a hierarchy there. But so settlement is one way to get at hierarchy, but there are other pathways which are complementary to getting at hierarchy. I point just to three very quickly. The fact that the settlement instrument has to be a kind of outside instrument, right? It can't be an inside instrument by construction. So outsideness itself is a feature of settlement. The unit of account has to be outside us. It has to be, so there's a hierarchy there. It can't be my unit or your unit, it has to be a third party unit. And also creditworthiness, right? So how do you, what is the instrument that ends up hierarchy? In other words, and a lot of this is foreshadowing stuff that will be in my book, is that how is it that certain instruments arrive at better creditworthiness, right? So money is credit, and the question is, better monies are better credit, and why? And one of the things I think that, one of the reasons that they are, is that you get kind of bigger balance sheets. Bigger balance sheets kind of, which are literally just scaled up, and they scale up through a process of what I call mutualization, of bringing banks mutualized by swapping IOUs, states mutualized by swapping IOUs, the political IOUs as opposed to commercial IOUs. And so some of the best monies are issued at scale because the swap of IOUs is happening over like 20% of global GDP, which is the dollar, right? That kind of mutualization is not happening as robustly, say, in Europe. It's not happening so China has scale, but it doesn't have the kind of plumbing. So this scale element, I think, is very important. This is not the point that all states have the best money, right? But the best monies are offered by certain states configured in certain ways. And I'll come on to that when I talk about the dollar system. The second, I'm just picking a few points for Alex from your broad kind of paper. The second point, one point you mentioned is that, this evolutionary kind of language that market formation, market practice is something kind of organic, bottom up, and so on. And it is to a certain extent, but I think we can overstate that there is, and this is, I think, we throw around the term neoliberalism a lot. But I think that, and there's a nice, brief, technical definition of neoliberalism, and indeed, Polanyi would say liberalism itself, which is that markets are actively constructed, right? Polanyi's entire point is that there was a kind of very directed political project by a set of intellectuals with class power who believed in what you call the liberal creed, that this is the best way to organize society. And they actively took state power and used state power to reformat society in that image, right? This is a violent process in many ways. This is not an organic process at all, right? This is the primitive accumulation of capital. This is the enclosure of the commons. This is enforcing of property rights in a particular way, right? So I don't think that this is, I think we can overstate the organic nature of that. Indeed, this is part of the old transition to capitalism kind of debate. Why is it that it happens in certain places and not others? It's because certain places have a bourgeois revolution and other places don't, right? And they have a passive revolution of capitalism as corruptions, and so on and so forth. So I think we can, which is not to say that this can be hothouse all the time. It's a very, very difficult thing to hothouse market economics, to hothouse capitalism. But where it succeeded, I think it has been, and this is going up to the present period. You talk a lot about, once it's established, then, right? But the whole, once a certain money is established, the whole problem is the establishment problem, right? This bootstrapping problem. How does a convention get off the ground to begin with? And so there's a kind of infinite regress there. And this again militates against a kind of organic bubbling up, right? That you do need a kind of coordination moment, even if that coordination is private, right? It's not as if, Royal's credit fairs are still private bankers coordinating, right? So this is active coordination. It doesn't have to be state coordination, but it has to be some kind of coordination, right? And so there's to get the same convention, sometimes you need a convention. There's a lot of I think the idea that money is created top down in Bretton Woods or something is false. But that's equally a caricature, and the kind of pure organic thing is also a caricature. And the truth is somewhere in between. These conventions happen periodically in history because you have to tidy up the kind of practice that has grown up, which is a hierarchical practice, and then you sort of move on, and then the next convention happens, and so on and so forth. So I think it's somewhere in between. You mentioned somewhere that the government is below the central bank in the hierarchy, and that seems wrong because what is the central bank's liability promised to pay? Right? What is on the asset side of central banks, implicitly and explicitly? Explicitly is government debt is the key asset sitting on the central bank's balance sheet. So that's explicitly backed by a certain kind of state debt, a non-monetary debt. I believe the central bank obviously are monetary debt. And implicitly, they are backed by the state itself, right? This fact is apparent only cyclically. So in a sense, in normal times, these appear as separate balance sheets. But in wartime, when this is really stressed, this kind of distinction, it's an important distinction because there's a functional distinction. The treasury doesn't issue money, the treasury issues debt, right? Which is a non-monetary form of debt. So you still need to convert that into something that we can, pay for coffee, and so on. And the reason this is important is that, the mere conventionality of money is insufficient to answer the question. A good theory of money needs to answer to the diversity of money, right? Why is monies are so diverse, right? So we need to be able to account for that diversity. Better money versus worse, right? And so variability on the asset side, variability over the economic catchment area over which the fiscal monetary machine kind of presides, I think allows us to kind of account for variability and therefore hierarchy. Also, I think it's important to make a distinction between the measure and what is being measured, right, in terms of the unit of account. Units of account are not in themselves valuable, they're just metrics, right? The question is what then is being measured by the standard. The standard itself doesn't create value, but it is measuring some value, right? And my claim is that one of the channels that, of course, there's an exchange value of money, you get things in the market, but there is another important channel to the value of money, which is thinking, and this is building on some older work of Perry's, is thinking about the fisc itself as a kind of value. that is backed by future tax flows, and those future tax flows are backed by your and my work projected into the future, right? So that is a kind of, through taxation, there's a kind of, it's an asset, it's a claim on productive resources. And the state has those best claims. But that's just touching on a few points. I'm sure we will have much more to discuss. Jay, a lot of the ground was covered yesterday, so I'll make just a few points about, why it has to be a national balance sheet over a multilateral balance sheet. The problem, as I was saying, is that, and you absolutely are right, anyone can offer crisis liquidity. The point is to get it accepted. So why is state-based liquidity accepted as opposed to non-state? Think of the distinction just between, forget now BIS or Banco for a second. Just think of the distinction between the EU and the Fed. The Fed can do things much quicker because there's a federal government, right? Whereas the EU has to, after long, and so multilateralism is intrinsically very hard. And that's the point, is that, but it also requires, which is what I was saying earlier, implicit balance sheet backing. What is the implicit balance sheet backing the euro? There is no European fist, right? Germany absolutely does not want the EU to become a transfer union. There is no Eurobond. In other words, there is no instrument which is sort of taking the whole of European GDP as its kind of cash measure, right? But there is, of course, a US one. So the nature of the mutualization is much more fragmented when it's interstate than it is with a single state. So it's not, we don't have to fetishize states, but you have to think about the kind of mutualization. There's a Kindleberger quote here where he sort of recognizes this, and I won't go into the detail of that. I talked about this dilemma yesterday. I'll just mention one thing about the private versus public dollar. You're absolutely right, it is a private dollar system, but the private dollar is a promise to pay the public dollar, right? That's why you have swap lines. If it were true, why have swap lines, right? So we have mutualized at the global level vis-a-vis the swap lines. But notice how partial the mutualization is. It's only lender of last resort, right? A full-throated central bank at the global level has other tools. It does other things. It does financial regulation. So it disciplines constituent banks, right? That disciplinary element is not there. It's just a fire truck. Right? It's just when everything goes bad, you wheel up the swap lines. The other big thing that it doesn't do, of course, is countercyclical discipline. Right? There's no countercyclical pricing of the swap lines, for instance, right? That there's you're lending freely, but not that much of a penalty rate, right? And you're certainly not varying that countercyclically. So you've mutualized only up to a point sufficient for emergency finance. But that still leaves us very short of replicating central bank functions at the global level, and again, that's a problem for multilaterals. Very quickly, Larissa, I love the framework, of course, of thinking about it in terms of alchemy, hierarchy, and instability, and I want to focus on two of these, but I want to make one general point, is that all of these features are attributes of credit. Right? And ontologically, tokens are not promises. They're things. They may have promissory elements, and we'll come to that. But they're not in and of themselves the liability of some issuing institution. Right? There's a very important feature of that, right? These are how all of these features stem from the nature of credit market, right? And the key thing with credit is that it's simultaneously flexible and stable, right? And that's a very tough trick to achieve at scale. It's flexible because it can be created and destroyed. That ability to kind of create and destroy an instrument that can function as money I don't see that as yet. And again, I'm not no expert. You know the domain, of course, much better. But it strikes me that rather than trustlessness, composability, and transparency, all of those features, those are kind of features important to the kind of crypto world. But what are the features important to the money world is that you could create, and why is that important? Because what's the source of banking? Right? It answers to the needs of the economy, but it answers to the needs of the economy in a granular fashion. It's the local bank. It's a and you have, right, this is the hierarchy problem, is that it is a distributed system. It's a hierarchical system vis-a-vis credit. And that's the genius of it's neither fully decentralized, nor is it fully centralized. It's a hierarchy, it's both, right? This, by the way, parenthetically, is my concern with central bank digital currencies, is that it's too centralized. And it doesn't have the kind of the other bits of the hierarchy. The hierarchy is functional, right? But the trick of a good, well-ordered credit system is that it's able to be both granular and centralized, both flexible and stable. And that feature, it seems to me, but we can talk about this more, is not as yet kind of represented in the crypto space, precisely because there is a hostility. Either it's one of two things. Either there's a hostility to credit because you want it to be a thing, or you just reinvented credit. In which case it's just banking again, and then, but we already have banks, so what's new? So I'll leave it there. Thanks. Should we gather the panel on the Yeah. So we have about a little over 12:30, so about 10 minutes. Questions?
Yeah, thank you all for being here. I'm gonna try to formulate my thoughts, and I think you've already helped me a bit, Anush, particularly in this naturalization of money. Because, as you said, there was actually throughout history a lot of violence attached to the imposition of currencies, especially under colonialism, and a lot of taking advantage of different registers of value, and this idea that money, as we now conceptualize it, is natural, really obscures, gift economies, non-money markets of exchange, and whole worlds that have existed, and like money, right? Like one of the things I didn't see necessarily underscored, right, is like money as a legal project, right, that distributes materials and defines authority as it operates. And yeah, like when I think about hierarchies today, like when I think about a Bangkok, the world is incredibly unequal along the lines of colonialism, and even within wealthy countries, the communities that are most marginal, I question, like, if we open everything, like, what would, I guess, yeah, like, and even Bitcoin, right, uses more electricity than some countries use in a year, right? Like, while we have so much electricity, so I guess when I think about, are we talking enough about our vision, right? Like money, if we think about just tinkering with money, right, are we missing the political vision that would need to drive any project, like even like about the world that we want to live in, and globalization, for instance, when we need globalized money in a globalized world, is that something we want to lean into, globalization, in an era of climate change? Like, where is local currencies, where are complementary currencies, where is actually resisting the dollar, where is subverting it, realistically speaking, the power dynamics? When I think about hierarchy and centralization, like colonialism and neocolonialism and how disempowered actually local communities are, like when they can't even eat the food that they grow, because it's being exported and stuff. I guess, so I don't know if I really have a formulated, I guess I invite responses on, like how you're relating to the material world and the interrelationships and interdependence between people and communities and countries, and the need for like reparations or within these questions, and maybe how naturalizing money is sort of dangerous, because I guess Katarina Pastor wrote, throughout history, it's really been, it's not just Minsky, you have to get someone to accept it, you have to get the state to enforce it. You have to get courts to recognize the new instrument. Oftentimes there was lawyers coding new forms of wealth. Even merchant IOUs were later upheld in courts. There's significant state power. So those are some of the questions I would have liked to have seen in the conversation.
Great, thank you. Should we gather a few other questions?
I think there's enough there, then we can.
Let's go.
Let's
More questions, okay.
Let's go, yeah. Go ahead.
Hi, thank you. Aaron Medlin at UMass Amherst. So I guess my question would be for Jay. So it, you had like a little point in your slide about how the Fed has been a little more generous, I guess, with this liquidity, right? And so we see some sort of recognition, I guess, by the Fed of some of its responsibility to sort of shore up the system. But the Fed ultimately does have a domestic mandate. And the way I see it is a big motivation of the Fed to supply swap lines was to provide liquidity to the Eurodollar system. But precisely because that system was, by it breaking apart, was interfering with the transmission of domestic monetary policy. In particular, the way it had an effect on LIBOR, right, the London interbank rate, which is set based on the Eurodollar market, right, and interbank lending in London by international banks. That was its primary motivation to provide swap lines, to provide them to in unlimited amounts, right, to certain countries, because those countries predominantly have LIBOR panel banks. It did end up providing swap lines to other nations, but those countries also basically get their funding from those markets, right? So the whole idea of alleviating kind of the Eurodollar system, it was really to reestablish its monetary control, right? So it's very motivated by its domestic mandate. And that was true of other central banks as well, right? You have the breakdown in international currency markets. We have such an integrated system in all these different key currencies that central banks are struggling to basically maintain monetary control. And one of the ways they're attempting to reassert that control is through swap lines.
Great. Does the panel want to take any other questions from the floor? Okay, we have about 6. Sorry.
We do have one right here.
Sorry, go ahead. Sorry. Yeah, then we can go in.
Thank you. I'll try to keep this brief. I was interested in a possible disagreement, I believe, if I'm correct, between Alex and Anush, or whether we conceptualize the central bank of the government as the one kind of being on the top of the hierarchy. If I understood it correct, Alex is emphasizing a price level of consumer goods as being stabilized by a central bank, and Anush is emphasizing that the assets the central bank uses to stabilize that price level are government assets. So my question was for Anush, what is Alex missing about the specialness of the fact that it's the government assets being used? And how do you rate the importance of that stabilizing decision being made by the central bank?
Great. So should we go perhaps in reverse order? Larissa, where to start?
All right, so just some thoughts on, I would say, this frustration around like what does it mean to be a citizen in a world where there is so much that has been predefined and there's such an architecture and structure that feels so weighty. how do you interact with the system? Because ideally, our systems would be stable enough to provide structure, but flexible enough to provide a reimagining with each generation that comes by, and like a fit for purpose for what is the new visions that are being dreamed by society. And I would say it is hard to grapple with just the size and the weight. The reason that I'm interested in digital assets and crypto is because it is an exploration, it's an attempt from the bottom, trying to, and it's peanuts relative to the actual size of the systems that were being discussed. And not to say that there's not complications in ways that is problematic and use of energy resources, but it's also concentrated to certain parts and not others. And even if they're reinventing or rediscovering some constraints that existed in the past, it is an attempt to reconceptualize and reimagine a way to bring the fabric together. Not to say it's the only one or the best, but that is the reason that I'm interested in it, because it's an attempt.
What's your name again? Lily, okay. So you said money is not for everything. That I 100% agree with that. There are plenty of really important things in the world that money is not for, and there are a lot of important problems that can't be solved with money. I was trying to get at some of that in my talk in terms of like constraints on what we could do with money. So there's a lot of things we can't do with money. Money is not for everything. But money is for some things, and it's for some important things, and that just happens to be, the area that I'm focusing on. And I think, this conference is oriented toward money. So money is important. It's not the only important thing. I agree with you on that, and many of the things you said are very, very important. You had a specific question: should we lean into globalization in a world with climate change? And that's interesting to me because if everyone is self-sufficient, right, that is much more resource intensive. The more we can cooperate and economize on resources, the lower the emissions are going to be, the better it's going to be for the climate. So there's an argument to be made for, if you want monetary sovereignty, you have to kind of cut yourself off from the global market in certain ways, and you have to do things that are inefficient and potentially more wasteful with resources, that kind of thing. But there's still an argument to be made for that, but it's a climate cost. It would be a climate cost. You'd be trading off, you'd be like, I want these countries to be more self-sufficient, more independent, and part of the cost of that is climate related. So it's more, I would say that argue that globalization is more in line with better climate results, probably. And then kind of to front run Anush here on Derek's question. I was not I was talking about the central bank stabilizing prices, but in terms of the order of the hierarchy, I'm constantly thinking of who's using whose liabilities as money. So on the central bank's balance sheet, yes, they have treasury securities as an asset, but all banks have assets, right? So they expand their balance sheet on both sides. Just because they have an asset on their asset side doesn't mean that that asset is money. Only certain things are money on the asset side of a bank, and that would be their reserves of cash. The Fed doesn't have a reserve of cash because there's no money above the Fed. There is still a hierarchy. It's stabilizing relative to purchasing power in much the same way that a gold standard bank, central bank stabilizes against gold, but gold is a higher form of money in the gold standard world. So there's really no money on the balance sheet of the Federal Reserve. Now you could say that other central banks internationally, they have reserves of treasuries on their balance sheets. So you could make the argument that treasuries are like money to other central banks, but it's not money to the Fed, right? The Fed's liabilities, the Fed's reserve or deposits in the Fed, those are money to the banking system and they're money to the government. So the government is using the Fed's liabilities as money. So that's the structural hierarchy I'm talking about. Now, of course, you have a situation where the government completely dominates the Fed, can tell it what to do at any time. You're my bank, but I can make you lend me money, that kind of thing. Okay, sure. So in that sense, maybe the government doesn't have a settlement constraint because it can control its bank, but structurally, it's still using that central bank's liabilities as money. So the structural hierarchy is what I'm emphasizing.
these questions, because I think they really get at the heart of a couple of questions, which is, how do we grapple? Part of the reason we want to have this panel is that we have a world that's hierarchical, we have a world that's centralized, we have a world that is sort of unequal, inherently unequal. So what we can sort of resist and try to break it into its pieces, and then basically what would that mean? I wrote my master's thesis on how Germany broke out of that system, and but it was a big country, it was a very powerful country in the 1930s to support the Nazi sort of system that would emerge independently of the Sterling system. There are ways to potentially do that. Are they better? It's not clear. But the key thing is, the starting point for me is all the panels have emphasized that there's a massive amount of capital needed for various projects to develop for global development. In this conference it doesn't come up very much, but global north, global south inequality is for me the starkest inequality. And how do you ensure that countries can actually have the adequate capital available to develop their economies, diversify their economies, become sovereign actors after they've developed? I don't think we can claim that any country is sovereign that is at the bottom of the hierarchy at the moment. So how do you have a more sovereignty comes with some sort of development that you can have within your domestic system. Then you have choices. Now China has developed. It has choices in that sovereignty now that it's developed its economic power, but it did not have sort of a choice to sort of do this as much as it is doing now. So just to be very pedantic about this point, but I think there is sort of a point about the unequal amount of there's abundant capital available. We have various green transition gaps, green finance gaps. We have development gaps. How do you square this? And the exercise here would be to sort of say, how do you, from a concurrency perspective, make sure that you start directing long-term capital flows, which was Hindenburger's imagination, to sort of stabilize the system. So one virtue would be stability, and we all agree with this. That one thing we all want is stability, and stability will induce sort of this long-term capital flow. And this gets to maybe I wanted to sort of quickly pick up on one more point that is sort of, I think, crucial. Like money is always being created. I think this is just one more example. The offshore dollar market is money that's just being created all the time. We cannot always choose. It's always a process. And the state does have, and these are when it's being created, it's a promise to pay. It is private. So we have this dynamic of private creation of money always, everywhere. And crypto is an example of this. The offshore dollar market is an example of this. The private banking system is an example of this. We can have local currency screens. The question is, what is the scale of the market? How far does it go? How far can you use it? And who accepts it and who backs it? I think these are all the questions where the state has an important role. And the question was, before the financial crisis, does the Fed actually backstop all this private money somewhere else? Does it validate those claims or not? That's, for the international system, was a hugely important question. And the Fed said, no, we're not going to give swap lines to the euro-dollar market. We would have a massive collapse of the European systems because we would have cascading failures, just like we would have cascading failures of banks and the money market domestically. Why? You already explained it correctly. Because these markets are hugely integrated. Whatever happens in Europe, with the integration you see, would spill right over into the US. So there is a domestic mandate for the US because it's one country, one capital market. It's just an extension of that system that sort of gives that mandate. So this is kind of the reason. This is also maybe the rationale why the Fed does not give it to other countries, because they're not integrated into the system. If they were integrated, they would give a swap line. It's a pretty obvious Hilbertian argument to sort of say, okay, and again, I was simply making the thought experiment. You have the choice to stay outside that system, but the arguments, the costs are pretty high either way. And I would like to just say that hierarchies exist no matter what you do. You can either grapple with a US bank or your local elites who simply free ride as a developing country off the status quo. In Brazil, we have huge entrenched interest of just staying in commodity exports and not diversifying other industries. You have, I shouldn't speak because we have other experts in Brazil here, but I think there are entrenched interests and power dynamics that are present no matter what. Being integrated in the dollar or not does not change the fact that this is a hierarchy. We have to grapple with this inequality no matter what. So, and I do think that the hybridity of the system is sort of the interesting exercise. How do you allow for exploration? How do you allow for other forms of economic activity? And then how do you validate that? And I think we now, we see this at various different places in the hierarchy, in various different contexts. So I think this is interesting in that sense.
Great, thanks, Jay.
It's kind of like we do have someone raising their hand a lot online. Maybe if the participants want to go, do you guys have time for one more question for
Is the audience ready for one more question? Okay, let's go on.
Also feel free to
Yeah, you can go.
You're free to go.
I'm gonna give this person, all right, so Ari, I'm going to unmute you and we'll give you time. Yep, so can you speak now?
Yeah, can you hear me?
Yes.
Yes, okay, great. And thanks a lot. Thanks very much for giving me the floor as well. So I just want to, I think Anush kind of politely stated that there is going to be huge problems of mistrust and distrust on the US as a leader in an international monetary system. So I just want to, I'm joining the conference from Finland. So in Northern Europe, a really small country, just 5 million people. But I'm a linguist actually, so I'm really, this analogy of Esperanto and English that you mentioned, that Kindleberger was referring to, actually, Esperanto is just an artificial language that basically combines features from the Romance languages like French and Spanish and Italian. So it by far, it's in no way like a neutral language. No, it's not. And also with the English, it's actually a bit, around the world, English speakers actually create their own Englishes that are not understandable to English speakers in the United States or the UK. So I don't know how this relates to the dollar-led financial system. Can they create their own systems within that? And also I want to just, because I've studied the history of colonialism and imperialism in Southeast Asia, I just want to mention that. And also I read a book that about tax havens and how an African person said that we are not trusting, it would be suicide to trust the Western countries with anything, and so on. So I think this kind of speak by Americans, and I'm going to be brutal now, and I don't want to offend anyone, I just want to make a rude awakening reality check. So, you know, people don't love the United States around the world, you know, and it's even called the Great Satan or something by some people and so on. So there is this huge problem of setting this system up, like Anush said. And I just want to point that out. And there is no reason for people from previous colonies to trust the Westerners at all. The history doesn't support that. So, and then Kindleberger said that if the Fed realizes its responsibility, that's a pretty big if. In Bloomberg, for example, there was an article that said that, you know, Jay Powell and the Fed just decided to say, screw everyone else. You know, we are fighting inflation in the US and, you know, we raised the interest rates and now the global South is in huge problems because of that. So this kind of, again, brutally, this kind of speak by US people reeks of manifest destiny. Like you're thinking that you are like this signal beacon of hope and enlightenment to the world, but a lot of the world doesn't see it that way at all. So there would be huge problems. And I'm sorry for being so brutal, but I just wanted to do a reality check here. Thank you.
Thank you very much. But I think with that, that's the room's empty now. So my thanks to the panel, thanks for inviting me, and obviously this conversation will continue. Great, thanks.